Traders War Room proudly presents the daily video with the best trading and investing alerts anywhere on any platform. With up-to-date stock, chart, and market news, TWR is simply your one-stop shop. TWR Tech Video. Activate your 2-day trial of TWR All Access on the Discord platform. Stay tuned at the end for TWR Hot Products and Services. I thought it'd be a good idea to go ahead and do a tech video on witching. Since Friday was a triple witching market day, I think you guys should understand exactly what this is. So we're going to talk about market witching, what it is, the difference between the quad and the triple, and things to watch for so that you can make some money. So you have to understand that witching is where contracts simultaneously expire, causing trading to soar, and specifically the last hour of trading. Now, because of the unusual price movement, sessions are dubbed the, quote, witching hour or Freaky Friday in stock market lingo. And this happens in both triple and quadruple witching. So we're going to talk about triple witching first, all right? So in folklore, the witching hour is a supernatural time of day when evil things may be afoot. Now, in derivatives trading, this has applied to the hour of contract expiration, often on a Friday and at the close of trading. So triple witching is the simultaneous expiration of stock options, stock index futures, and stock index option contracts all on the same trading day. Triple witching happens 4 times a year on the third Friday of March, June, September, and December. A common expiration date for the 3 types of equity derivatives can cause increased trading volume and unusual price action in the underlying assets. Now, triple witching days generate trading activity and volatility because these contracts that are allowed to expire may necessitate the purchase or sale of the underlying security. So while some derivative contracts are open with the intention of buying or selling the underlying security, traders seeking derivative exposure only must close, roll, or offset their open positions prior to the close of trading on triple witching days. You can see that triple witching days, particularly the final hour of trading preceding the closing bell, known as the triple witching hour, can result in escalated trading activity and volatility as traders close, roll, or out of their offset expiring positions. Single stock futures, they were last traded in the U.S. in 2020, were often grouped with the stock option index options and index futures, giving rise to the term quadruple witching. But they never drew nearly as much capital or trading interest as the other types of equities derivatives, most notably the stock options. Now, let's talk about offsetting future positions. So, future contracts, which is an agreement to buy or sell an underlying security at a predetermined price on a specific day, mandates that agreed upon transaction takes place after the expiration of the contract. So, for example, one E-mini S&P 500 futures contract is valued at 50 times the value of the index. If the S&P 500 is at, say, 4,000 at expiration, the value of that contract is 200,000, which is the amount of the contract owner is obligated to pay if the contract is allowed to expire. To avoid this obligation, the contract owner closes the contract by selling it prior to expiration. Now, after closing the expiring contract, exposure to the S&P 500 can be maintained by purchasing a new contract in a forward month. This is referred to as rolling out the contract. Much of the action surrounding futures and options on triple witching days are focused on offsetting, closing, and or rolling out positions. On the expiration date, contract owners can choose not to take delivery and instead close their contracts by booking an offsetting trade at the prevailing price. This is setting the gain or loss from the purchase and of the sale prices. Traders can also extend the contract by offsetting the existing trade and simultaneously booking a new options or futures contract to be settled in the future, a process which is called rolling the contracts forward. Now, options that are in the money present a similar situation for holders of expiring contracts. For example, the seller of a covered call option can have the underlying shares called away if the share price closes above the strike price of the expiring option. In this situation, the option seller has the option to close the position prior to expiration, to continue holding the shares, or allow the option to expire and have the shares called away. Now, call options expire in the money and are profitable when the price of the underlying security is higher than the strike price in the contract. Put options are in the money when the stock or index is priced below the strike price. In both situations, the expiration of the in-the-money options results in the automatic transaction between the buyer and the seller of the contracts. As a result, triple witching dates lead to an increased amount of these transactions being completed. Though much of the trading in closing, opening, and offsetting futures and option contracts during triple witching days is related to the squaring of positions, the surge of activity can also drive price inefficiencies, which draw short-term arbitrage. These opportunities are often called the catalyst for heavy volume going into the close on triple witching days, as a trader attempts to profit on small price imbalances with large round-trip trades that may be completed in seconds. Now, here's a real-world example of triple witching. So Friday, March 15, 2019, was the first triple witching day of 2019. Trading volume leading into the third Friday of the month saw increased market activity. So according to Reuters report, trading volume on March 15, 2019 on U.S. market exchanges was 10.8 billion shares compared to the 7.5 billion average over the past 20 trading days. For the week leading into triple witching Friday, the S&P 500 was up 2.9%, while the NASDAQ was up 3.8% and the Dow was up 1.6%. However, it appears much of the gains happened before triple witching Friday because the S&P was only up 0.5%, while the Dow was up only 0.54% on the Friday. So traders care about this because several derivatives expire at the same moment, and the traders will often seek to close out of all of their open positions in advance of the expiration. This can lead to that increased trading volume and intraday trading volatility. Traders with large short gamma positions are particularly exposed to price movements leading up into expiration. The arbiters try to take advantage of such abnormality in price action, but doing so can also be very risky. Now, here are some of the price abnormalities observed in triple witching, right? So because traders will try to close and roll their positions, trading volume is usually above average on triple witching, which can lead to greater volatility. And an interesting phenomenon observed is that the price of a security may artificially tend toward a strike price with large open interest as gamma hedging takes place. And this can lead to the price to pin the strike at the expiration date due to short of trading activity. Pinning a strike imposes pin risk for option traders, wherein they become uncertain as to whether or not they should exercise their long options that have expired in the money or very close to it. And this is because at the same time, they are unsure as how many of their similar short positions they will be assigned. Quit wasting money that isn't making money. Join the team and trade with TWR Bulls. All the links are in the description. Now, we talked about triple witching, so let's get into quad witching. So quad witching refers to the simultaneous expiration 4 times a year of stock option, index futures, and index future option derivative contracts. The fourth type of this contract involved in quad witching is single stock futures. However, this hasn't been traded in the U.S. since 2020 and was never a major contributor to equity trading volumes. What is now effectively called triple witching occurs on the third Friday in March, June, September, and December, and equity trading volume tends to rise on these days and is typically heaviest during the last hour of trading as traders adjust their portfolio. But we're going to dive into quadruple witching just so you're in the know and you have a baseline of everything witching. So now the 4 derivative contracts accounting for the quadruple and the quad witching are stock index futures, stock index options, stock options, and single stock futures. Now, we already went over that the single stock futures are not traded in the U.S., only outside of the U.S. The quarterly expiration of index futures and index options coinciding with the monthly stock option expiration produces the flurry of trading. Market makers who've sold expiring stock and index option contracts close out of the matched hedge positions, boosting this trading volume. Meanwhile, all this is happening, the rolling of contracts ahead of expiration also increases turnover in options and future market. An additional factor is quarterly index rebalancing, also known as reconstitution. This is taking place on witching day as well. That means portfolio managers tracking rebalancing indexes, including those from the S&P, the Dow in the US, and the FTSE in the UK, FTSE in the UK, may need to make trades reflective of index changes. Now, when we're talking about the types of contracts, we need to understand that quad witching are all about, and we need to look at the 4 classes of contracts that can expire at these dates since we have a little bit of knowledge. So stock options, right? Options are derivatives, which means they derive from the value of the underlying securities, such as stocks. Option contracts give a buyer the right, but not the obligation, to trade a set number of shares of the underlying security at a specific strike price at any time before option expiration. Now, I know this is basic, but we're just covering all baselines in case someone is listening to this video for the first time. So there are 2 types of options, right? A call option, which may be purchased to speculate on a price increase of a particular stock. If the share price is higher than the strike price on the option's expiration date, the investor can exercise this option to buy 100 shares of the stock at the strike price and resell them at a higher market price, or may simply sell the option at a profit before expiration. Put option lets the investor profit from a decline in the stock share price as long as the price is below the strike at expiration. Monthly stock option contracts expire on the 3rd Friday of every month, and option buyers pay an upfront cost known as the option premium. Index options work much like a stock option contract, but derive its value from that of an equity index rather than a single stock share price. The value of the underlying index relative to the option contract strike price is what determines an index option trade profitability. As with stock options, index options don't confer an ownership interest. In contrast, the stock option index options are cash settled. Another important distinction is that index options are European style, meaning that they only are exercised on expiration date, while stock options may be exercised at any time before the expiration date. Index futures are contracts that are legal agreements to buy or sell an asset at a determined price at a specific future date. So future contracts are standardized with fixed quantities and expiration dates. Futures trade on futures exchanges, and the buyer of future contracts is obligated to buy the underlying asset at expiration, while the seller is obligated to sell at expiration. Index futures such as cash settle at expiration at the specific price and with the value of the index at the time determining the trade's profitability. So, like index options, index futures can be used to hedge a portfolio of stocks, limiting the damage from, say, a bear market. In a bear market, a trade selling a futures contract earns a profit, offsetting the stock's portfolio loss. The goal is to minimize short-term losses for long-term holdings. Now, going into this, even though we don't do this anymore, single stock futures are obligations to take delivery of shares of the underlying stock at the contract's expiration date at a specific price. Each contract represents 100 shares of a stock. Holders of stock futures don't receive dividend payments, and even when single stock futures traded in the U.S., they were a minor market segment relative to the trading flows in stocks, options, and the index options and the futures market. Now, one reason the combination of monthly and quarterly derivative expirations generate heavy trading volume is that in-the-money option contracts are subject to automatic exercising, which require the delivery of the underlying shares in the case of all call options. Call options are profitable when the price of the underlying security is higher than the option strike price, and put options are in the money when the stock price is below the strike price. In either case, the expiration of the in-the-money option results in increased trading volume as the underlying shares are bought or sold to close out the option trade. Despite the overall increase in trading volume, quadruple witching days do not necessarily add to the market volatility. Now let's talk about closing and rolling, okay? So much of the action surrounding futures and options on quadruple witching days focus on offsetting, closing, or rolling out positions. A future contract contains an agreement between the buyer and the seller in which the underlying security is to be delivered to the buyer at the contract price at expiration. And so let's do an example with the E-mini S&P again, right? Futures contract is worth 50 times the value of the S&P. So if the value of an E-mini contract with the S&P 500 is at 2100 at expiration is worth $105,000. This amount is delivered to the contract owner if it is left open at expiration. Contract owners don't have to take delivery on the expiration date. Instead, they can close out their contracts by booking and offsetting trade at the prevailing price by cash settling the gains or loss from the purchase and the sale price. Traders can also roll their contracts forward, a process that extends the contract by offsetting the existing trade and simultaneously booking a new option or futures contract to be settled in the future. Now let's go into arbitrage, right? Some opportunities. So over the course of quad witching day, transactions involving large blocks of contracts can create price movements that may provide arbitrary to the opportunity to profit on temporary price distortions. So arbitrage can rapidly escalate volume, particularly when high volume and trips are repeated multiple times over the course of trading on quad witching days. However, just as activity can provide the potential for gains, it can also lead to very quick losses. So some pros and cons, right? Pros give arbitrage the opportunity to profit on temporary price distortions. Increased trading activity and volume can lead to market gain. Some cons is that the market gains tend to be fairly modest, and the potential for losses can be equally as evident as the potential for gains. So when does quad witching occur? Well, stop options contracts expire monthly, while index futures and options typically settle on the third Friday of the March, June, September, and December. So why do traders care about quad witching? Well, when several categories of derivatives expire on the same date, the trading volumes tend to rise as the money options are exercised while market makers square off setting hedges, and this what causes the volume rising with implied volatility and thus our reason for trading to make money, and there can be a lot of it made with the hectic trading volumes. So there's an interesting quirk, and it's with the price of a security may artificially tend towards a strike price with large open interest as gamma hedging takes place, a process known as pinning the strike. And we talked about this earlier, but let's go back into it because just like with triple witching, this is the same thing with quad witching as well. And you guys need to understand this because this is what makes trading on the day get so much money. So pinning a strike imposes the pin risk for option traders, where they become uncertain whether or not the options with strike prices near the market price will finish in the money or be exercised. This is what drives some volume trading. Also, implied volatility, which of course we like as traders because this is what gives us that dramatic shift in the underlying asset, which can increase profitability on our trades, whether we're long or short. So, in conclusion, witching has a long history of being a market frenzy event, but it isn't an unexpected event as the time and dates are known. Potential for dramatic moves are possible due to the unusual volume activity and the associated price action. So, having a plan is essential, and paying attention to the trend is very important on these days so that you can make the money riding the wave. And I hope I have provided you with some sort of value and knowledge with this particular video and given you some ammo for your weapon, which we know, of course, is the market warrior in us. As always, TWR is here to bring like-minded traders and investors together so that you're not alone in your trading journey. And our goal has always been and will continue to be to grow, learn, share, and hopefully make some money as a team of market warriors. And I just want everyone to be ready to ride the wave, attack the trend, and destroy the market. And as always, let's go to war together. Enjoy your weekend. I'll see you guys when that trading bell rings on Tuesday. TWR Hot Products and Services. On 25 June, we got the TWR Gap Trading 101. I'm going to teach you guys how to destroy gaps to destroy the market. This is going to happen 25 June at 1 p.m. Central Standard Time. $15 gets you a seat, and everybody gets the recording. TradersWarRoom.com/upcoming classes. You can sign up right there, and that link is in the description. Activate your 2-day trial of TWR All Access on the Discord platform. We cover it all at Traders War Room, whether you're looking for stocks, options, futures, forex, crypto, or even sports betting, or you want real-time alerts, live trading, algo signals, or even if you just want to be part of a community of like-minded investors to grow, learn, and share together as a team. Something for everyone, every budget, and every style. Join TWR today and trade with the bulls. Join the TWR Investment Club. Are you tired of trading alone, losing more than you're winning? Or are you just too busy with work, family, and life to focus and hit the market bullseye? If that's you, then join the TWR Investment Club. We trade the account for you and then pay you profit and loss distro. We run both a 30-day and a 6-month club. Next club starts 1 July 2023. Sign up opens 15 June. And the link to join the free chat where you get all the information is in the description. Traders War Room is your one-stop shop. Try our TWR one-to-one mentoring. Does the market have you feeling like this? Or wanting to rip your hair out while you watch your account dwindle? If that's you, then Traders War Room has you covered. Our one-to-ones focus on you as a trader or investor. The Zoom session connects you with a TWR professional. Whether we're covering charts, developing a plan of attack, or being strategic and deep diving on the how, why, and execution of trade plans. TWR one-to-ones will give you the confidence to attack, conquer, destroy, and make the market bend the knee in 2023. Join TWR and bow to no one. Book your session today. The link is in the description or on the website at TradersWarRoom.com. Let's go to war. The market is our war zone and stocks are the battle. Join TWR and let's go to war.